With the economy improving and consumers struggling financially, officials are set to hike interest rates. While gold is stuck in between the booming stock market and cryptocurrencies, Federal Reserve policymakers are deliberately trying to cut back on their pandemic-era stimulus, capping a difficult year with a policy shift that could eventually bring in higher interest rates in 2022. Today we'll talk about how the pandemic has directly affected inflation rates, as well as how the shift in consumer preference towards digital currencies has shaken the value of gold, so stay tuned. Inflation rates and economic normalization. The Fed's policy announcement signaled a faster end to its monthly bond buying program, which has used to keep money flowing through markets and boost growth throughout the pandemic. Officials aim to hike interest rates 3 times next year, according to a new set of economic estimates announced recently. Before raising rates, the Fed has made it abundantly clear that it wants to halt its bond buying scheme, which would dampen demand by making it more expensive to borrow for a property, a vehicle, or developing businesses. As a result, growth and eventually price increases would be hampered. According to the Fed's updated economic predictions, rates could rise to 2.1% by the end of 2024, after being at rock bottom since March 2020. The Fed's final meeting of the year marked a clear move away from full throttle economic recovery and more towards avoiding the risk of rapid and long-term inflation. While officials spent much of the year setting out a meticulous plan for weaning the economy off the Fed's monetary support, they've been increasingly concerned that a price spike this year will persist, prompting them to take a stronger approach. The pandemic's effect on the economy. Certain economic experts have cautioned that if the new Omicron variant of the coronavirus progressively interrupts supply chains and leads industries to close down for longer durations, it might allow excessive inflation to stay. The spread of the virus is a threat that adds to the uncertainty in the economy. The advent of the Omicron variety, as well as an increase in COVID cases in recent weeks, poses a threat to the global economy. Many analysts have expected significant price increases to dissipate rapidly as the economy went through a rocky reopening period following lockdowns to limit the virus and its effects on the economy. After Labor Day, there was a clear turn in the right direction, with the employment market showing hints of improvement and inflation readings remaining low. Wages rose considerably in the Employment Cost Index, ECI, which gauges how much firms spend on their employees. As global shipping routes clear backlogs, factory production starts to rise to meet demand, and consumers return to more normal spending patterns after scrambling to buy lawn equipment and stationary bikes during the pandemic. Policymakers remain hopeful that inflation will fade back toward the Fed's 2% annual average goal. The Fed's shift in tone and approach appears to have been made easier by the strengthening labor market. Because the employment market is quickly recovering, officials may be less concerned about slowing it down while they try to keep prices under control. So how much has employment improved? The employment rate has dropped from double digits early in the pandemic to 4.2%. Despite this, many people are still unemployed, some due to retirement, while others are unable to work due to disease anxieties or a lack of health care. As a result, determining how close the economy is to the Federal Reserve's goal of economic growth is difficult. Because the epidemic had interrupted people's working lives in substantial ways, returning to a higher participation rate could take time. The Fed would not be able to raise interest rates if the labor force participation rate fell. A complex strategy would be required to persuade people to return to work. To do this, policymakers and the government as a whole must ensure that price stability is maintained. The Federal Reserve may hike interest rates soon. There have been rumors that interest rates could be raised as early as next year in order to combat stubbornly high inflation. The central bank disclosed their plan to phase off its large-scale bond buying program faster than planned at the end of a 2-day policy meeting. During the pandemic, the Fed began buying bonds in order to keep borrowing costs low across the economy and avoid market disruptions. Ending the bond purchases earlier would allow the Fed more leeway to raise interest rates sooner if needed, to prevent price inflation from spinning out of hand. Prior to considering hiking interest rates, the central bank stated that it wanted to stop buying bonds. The Fed has taken a tougher stance on inflation after consumer prices increased 6.8% year over year in November, the highest increase in nearly 4 decades. The Fed acknowledged the sharp sharp rise in prices in a statement, although the central bank continues to believe that factors related to the epidemic drive inflation, which should decline as the health outlook improves. Officials are no longer assuming this as a given. There are economic costs to higher interest rates. In order to keep the economy afloat during the epidemic, the Fed held interest rates near zero. Interest rates are expected to climb by 0.75% or more in 2022, according to 12 of the 18 members of the Fed's rate-setting committee. This demonstrates how the Fed's perspective has changed over time. No one on the committee expected rates to rise by that much next year 3 months ago. This year, the Fed has been frequently shocked by the strength and persistence of inflationary factors. While average incomes have been rapidly increasing, prices have been growing even faster. Even if earnings are rising, inflation is surpassing wage growth, which is bad for people. As a result, everyone's living standards are deteriorating. Higher borrowing costs usually mean weaker economic growth, so the Fed has been hesitant to boost rates until it believes the U.S. has reached full employment. Inflation and gold. Gold is considered a critical inflation buffer, and with prices rising, the value of gold should be sky high right now. That isn't the case, however. Instead, gold's been trapped in a 4-month range of $1,725 to $1,830. Why aren't investors rushing to acquire gold in these uncertain times, given that it has been a superb store of value for over 4,000 years? Is the current economic downturn a purchasing opportunity or an indication that gold isn't as appealing as it once was? Let's talk about it. What's driving investors away from gold? In the face of slowing global growth, supply chain constraints, rising energy prices, and persistent pandemic fears, gold should be doing much better. However, there's enough good news to make up for it. With a strong start to the third quarter earnings season, corporate profitability remains strong. While sustained consumer demand, the need to rebuild low inventory levels, the major climate and infrastructure expenditures could help to extend the economic cycle even further. Most economies are remaining open as a result of the COVID-19 vaccine campaign, which lessens the demand for a safe haven. Investors are concerned, but not enough to invest in gold. Even if inflation accelerates, gold prices are not guaranteed to rise in tandem. The central bank is expected to raise interest rates to battle inflation, according to the market. The European Central Bank is reducing the pace of its monthly asset purchases, while the Federal Reserve of the United States is hinting that rate hikes are on the way. Even the trade war between the United States and China isn't helping gold. As a result, investors are once again concerned, but not sufficiently so. People are still investing in gold, but they are shifting their focus away from gold and more towards other types of investment. Can the US dollar manipulate gold value? Yes, the steady recovery of the US dollar during the pandemic has held back the value. Because gold is priced in dollars, when the value of the dollar rises, it becomes more expensive for buyers in other currencies, reducing demand. Digital currencies, on the other hand, are gaining in popularity and value, eclipsing older forms of money. Isn't gold, like real money, beginning to look a little out of date? Mike McGlone, a senior commodity strategist at Bloomberg Intelligence, believes gold is an analog store of value that will be surpassed by digital currencies such as Bitcoin or Ethereum, which he believes are on their way to becoming digital reserve assets. Are cryptocurrencies a threat to gold value? The success of Bitcoin and cryptos now has a vested interest in the West, as it might usher in a new digital international structure. However, not everyone's satisfied, with some referring to Bitcoin as digital gold. The fact that Bitcoin's price has doubled, then doubled again, does not prove that it is a store of value. Cryptocurrencies, according to Boris Ivanov, founder of mining company Emerald Resources, cannot match gold's long-term track record. Despite the hype, they are unanchored currencies with extremely fluctuating values, unlike gold, which has proved to be a safe investment for generations. The basic truth is that investors are avoiding gold in favor of cryptocurrency because it offers better yields. Even equities and real estate become more appealing to investors as inflation rises, as they tend to do well. By comparison, stocks have produced double-digit returns this year, so gold will lose its attractiveness. These are difficult times for gold, and they today are unlikely to improve. The Fed is expected to raise interest rates twice in 2022, according to the markets. This might keep the US dollar and Treasury yields high, putting downward pressure on gold prices. Thanks for sticking around till the end of the video. If you liked watching our content, please leave a like, share, and subscribe to our channel.